Editor-in-Chief of DevX, back again with my series of interviews with global leaders during this pandemic. We have now had conversations with dozens of leaders across disciplines across the world, and I'm really honored and excited to be joined by Dr. Vera Songwe, who's of course the Executive Secretary of the UN's Economic Commission for Africa. Nice to see you, Vera.
Hi, Raj. Hi, nice to see you. Good to see we're all doing well.
Yeah, we're doing okay. It's hard to believe we're months and months into this now. I think there's over 30 million known cases around the world, over 1 million deaths now, tragically. We want to zone in a bit on Africa today, since you have a high-profile role on the continent. Of course, it's a very diverse continent, 54 countries. But big picture, it seems to have done remarkably well on the health side when it comes to the virus, but much bigger challenges on the economic side. How do you see overall where Africa is today in this moment as we battle this global pandemic?
I think Africa, again, thanks for having me, and hello to everybody else. And listen, we just had the final conversations, or at least the final high-level conversations on the Financing for Development Forum, organized by the Secretary General, the Prime Minister of Canada, and the Prime Minister of Jamaica, where we had almost 20 heads of states from across the world, and about 10 or 15 from Africa, talking about the crisis. I think what we can say is, you're right, Africa has done much better than expected. We haven't seen on the health side, the kinds of disasters that we're expecting. Unfortunately, of course, we are marking the 1 million deaths in the world today. But on the economic front, Africa is bleeding. We're bleeding because we are a continent that is very dependent on remittances. We're bleeding because we're a continent that is extremely dependent on commodity prices. We're bleeding because we're a continent that began to become a very intense service sector economy. Tourism, entertainment was part of what was keeping our jobs and keeping our women and men at work. And all those sectors have shut down. The Economic Commission for Africa did a report that said that, for every month in lockdown, we were losing about 2.5% of our GDP, or about $69 billion. That's a lot. Unemployment is probably going to go up. We're estimating about 30 million. Very difficult to talk with certainty about any kind of numbers these days, because, it's changing every day. But I think we have been quite resilient. However, I don't think that we can lay on our laurels and say, we're doing well, this is all going to go away. The longer I think the crisis takes, the longer it takes for our economies to reopen fully, the more painful it's going to get. And then we will start seeing some unraveling of our economies. And that is why, we're talking about first providing additional liquidity to this economy so they can begin the response immediately before we get into, what is inevitably going to happen, which is probably some debt restructurings across some of our economies. And we're beginning to see some of that happen.
Yeah, let's get into some of that in more detail, because the global response has been mostly health oriented for understandable reasons. A lot of focus on the ACT Accelerator and the big pledges that are going to need to be made there to fund vaccines and treatments and diagnostics. The virus, we're a full second wave in much of Europe. The US has plateaued perhaps, but most experts seem to think we're going to have another second wave here as well in the winter. So the prospects for commodities, for tourism, they're not great when you think about the economic conditions in Africa. You've been pushing, along with many other leaders, for debt relief of some kind. We had a suspension of interest payments the G20 agreed on through the end of this year. I think it was just a week ago or so that Zambia announced that they may well need to get their creditors to be work with them in some kind of a restructuring, potentially even some sort of a default. There's a lot of risk and worry about other countries having kind of a distressed situation when it comes to all the debt that was built up over the years, including from Chinese banks. What's your take on where we are today on these debt negotiations? Are we likely to see something substantial, something significant? It feels like we haven't had that much action yet on this front.
No, so thank you, and that's an important point. I kind of like to unpack this conversation into 3 bits, if you don't mind. Yeah. The first one is, because when we talk about debt relief, it gets mixed up. I would sort of rather talk about first sort of liquidity support, as the first step. And in the liquidity support basket, we talk about, providing additional financing to the multilateral development institutions, the World Bank, the IMF, and the regional development banks, so that they can, further on lend at much concessional rates to emerging markets and to Africa in particular. We're asking, as Africa, and our finance ministers ask for about $100 billion a year, every year for the next 3 years. And so that's the first part of the liquidity, is provide more concessional funding to those countries. And let's remember that the developing world today, to the tune of about 13 trillion, has given itself additional liquidity. So we're not asking for anything special. We're saying, let's do the same, let's level the playing field. The second part of the liquidity conversation is what we're calling the Debt Service Suspension Initiative. And many people forget that this was an initiative that came out of the African finance ministers meeting, which essentially said, at the time, because this was March, April, African finance ministers still believed that, we hadn't seen the beginning of this pandemic, and we thought we could go through it. So they thought, we don't want, over the board, across the board debt cancellations right away. Just give us time with the debt service payments. And that has proven to be a very powerful ask, because, for those who have benefited from it, it has given them some additional liquidity so essentially the resources they would have used to pay their bilateral creditors, they're now being able to use to address the pandemic, address the safety nets issues. However, it's not enough, because now we know 7 months later that the crisis is much deeper. You're talking about a second wave, so it's probably going to be with us much longer. We're looking for a vaccine, but it's not here yet. So we're now asking for an extension of that through next year, which should provide the continent with somewhere in the order of about $3 to $5 billion if all the countries make use of it. But we also want it to be extended. Initially, the initial debt service suspension initiative was really only for low-income countries and some least developed countries. But we now see, as we've said, tourism, commodity prices are affecting even middle-income countries.
Countries like Kenya, for example, are significantly affected.
Countries like Seychelles, countries like Morocco, all tourism economies, countries like Cape Verde have been significantly affected. So we would like all of these countries to have access to the debt service suspension initiative, which just says don't pay your debt service for your interest payments for another year. So that's the second thing. And we would like all countries that signed up to the G20 initiative, including, of course, the non-7 G20 countries, to participate in this initiative. So Saudi Arabia, Turkey, India, and of course China are part of that bunch of countries that we would like to, because Africa's debt, as you know, before the early 2000s was mostly bilateral OECD debt. Today we have debt from a much larger range of countries that are not G20 countries.
Well, and a lot from private creditors as well.
And finally, I was going to go to the private creditor side. On the private creditor side, what we are proposing is to say we can create, there's trillions of dollars out there in private sector hands that are earning negative interest rates. However, one of the pressures that we're facing in many of the developing countries, and in Africa in particular, is that our spreads are quite high. And so if we can reduce the spreads, essentially what is debt? Debt is the cost of your money. If the cost of your money is quite high, your debt to GDP levels become quite unsustainable very quickly. If we can reduce the cost of money, then we can extend, your sustainability out a little bit.
And how, Vera, would you do that on the private side? Because that seems to be much of the sticking point. I interviewed David Malpass, the president of the World Bank, and he said, we're trying to push private creditors, but it's not clear to me what the mechanism is or where the leadership is to really organize private creditors to say you're going to have to accept some kind of a restructuring or just play part of a debt service suspension kind of a initiative. Is this really, where do we stand with the opportunity to make this happen?
So there's a couple of different areas of doing it. One, of course, we're asking for the SDRs, which is a special drawing rights, which is an additional, if you remember in 2008, 2009, when there was a financial crisis, the OECD countries, the G20 countries got together and provided themselves with a little bit more resources. The central banks printed money and gave additional resources to these countries. We're hoping that, the unused SDRs of the 2008-2009 crisis can be reallocated to emerging and frontier market economies, and that may help buy down some of the interest rate costs of the private sector. Now there is a lot of discussion around whether, that is sort of bailing out the private sector. So there is another initiative called the Liquidity and Sustainability Initiative, which we're calling the Bail-in the Private Sector Initiative, which is to say the private sector does have the resources, how can we bail them in? So it's to provide them with some comfort. Remember, the private sector is not in this business to lose resources. And so it's how can you provide them with some comfort so they can come into this deal, provide much cheaper financing to the rest of the world. Maybe we can do some debt swaps, which allow us to exchange expensive debt for cheaper debt and provide countries with slightly longer term maturity. So it's not about them taking a haircut on the past, but it's sort of taking a haircut on the future, right? So the return on their investment going forward will become much lower because we've reduced the cost of borrowing from. And then just to give you a sense, today when Egypt goes to the market, its yields are about 14%. South Africa is about 9%. Germany is negative 48. So even if we were to bring negative, the Germans to, 10%, they will be getting a positive return, and we could on average, bring Egypt and South Africa down to 4, and that will reduce their debt sustainability much better and provide them with additional resources.
And what is going to be required to actually make this happen? What's the time frame? I mean, you're actively engaged in these negotiations. G20 is meeting this month in October. Should we be expecting some announcement in October or thereabouts? Is it going to be a grand deal, a global deal, or one-offs per country? How do you think this actually goes forward?
I like the notion of a grand deal. I mean, we're making some progress. Initially, there was the whole conversation around not being able to get some SDRs. We just heard today from Kristalina that Canada has been the first country to come ahead and provide SDRs to the global community. And so we hope that, some grand deal will happen between now and the end of the year, because if that doesn't happen, we will have many more countries. You mentioned Zambia. Zambia has not, I think, totally, they still have a couple of conferences with their creditors to decide what they do. But they clearly are one of the countries that has begun to indicate that they may be going through some stresses. We may have, before the crisis, we had 7 African countries in debt distress. And so we may see a lot more of them get into debt distress if some solutions are not found quickly.
And the spiral kind of gets worse. I mean, as an economist, if we wait and we will let the situation get much worse, it becomes that much more expensive to address, right? And this is exactly the argument for that 13.
This is the point, is to say, if we are, rather than wait for, default, and particularly disorderly defaults become a lot more expensive than if we had, and this is, I think, the other part of it, some countries will default. We know that. And so the other ask, I think, in tandem with the debt service suspension initiative is to say, can we begin to develop a framework for a sort of quick restructuring process so that there's clarity, there's certainty about how that would look like? So countries who may want to adopt that or go for it can have a sense of what it is that they need to do and say, fine, I don't want to do the DSSI, let me go for straight debt restructuring because I know what the criteria is. And I think the IMF and the World Bank have to come up with it soon enough.
And you're less likely to have a panic. I think that when the Zambian government announced that they may have a problem paying back debt, the value of their bonds were cut in half kind of overnight, right? So you want to avoid that sort of circumstance if you can.
It became 50 cents on a dollar, and we don't want that to happen to many of the African countries. The problem is also contagion, right? If there is no clarity about what the debt restructuring framework would look like, Zambia announces, and we see everybody else, getting a hit because everybody says, "Oh my God, Africa!" And because the risk premium on the continent is so thin, once one country sort of gets into trouble, everybody else begins to suffer the same fate.
So who is leading this today? Is this a G20 initiative in your mind? I mean, who do you look to for leadership on this issue?
I think leadership must come from the countries. Leadership must come from the African finance ministers who get together and say, this are our asks, this are our wants. And then you have the implementation process that then goes through maybe an endorsement from the G20 and the IMF, then that has to do a lot of the groundwork in terms of creating, because what we want is a comprehensive but harmonious framework so that everybody is playing with the same rules. There will be country by country negotiations that will be very important, and the IMF is, globally mandated to do this. So I think the IMF, once a country, again, leadership comes from the countries. Once countries, ministers of finance decide, this is where we want to go, then I think that the IMF should provide that framework for how it happens. As the Economic Commission for Africa, we're doing a lot of work to help countries, first of all, steer them towards, how do you assess the DSSI? What is it that we need to be, requiring from the international community, and what is it that they have to do in terms of governance, in terms of improving domestic resource mobilization, and other things that, some of this still lie with countries, and how countries have to use the additional resources they get.
You mentioned that first bucket, which is the $100 billion liquidity concessional finance from the multilateral banks like the World Bank. What do you want to see those multilateral banks, those regional development banks, do differently? I mean, when I talk to them, it sounds like they feel like they're doing what they should be doing. They've really stepped up. Do they need to go back to their shareholders for additional finance? Can they just do more themselves? Are they being as aggressive as they should be given the crisis?
So in the first bucket, which is liquidity, the first thing is we actually asked to recapitalize MDBs. To the tune of $100 billion so that they can then on-lend. We ask for SDRs, which essentially means give more money to the IMF so that it can on-lend. And so I think that is part of the first bucket. The second bucket, of course, is the debt restructuring framework that needs to be put in place. But really, when we talk about getting out of this crisis, or even managing to sort of put a floor, as Kristalina would say, to this crisis, we also need to support the private sector, because that's where the jobs are happening. That's where we're ensuring that people, don't fall into poverty. So there is also liquidity that needs to be extended to the private sector for, we need trade credits. We need to ensure that there is working capital, so that even the health response requires that our private sector stay afloat and remains in business. So that those will be sort of the three buckets. It's liquidity, debt restructuring, and then ensuring private sector has access to more financing to continue to hire and continue to do more resilient sort of growth as we go forward.
And are they being aggressive enough on those points, the MDBs, or given the scale of this crisis, should there be more? I keep asking this in my series of leader conversations about,
of course, there should be
what are
more.
the big ideas?
There should be more. We're asking for 100 billion. We have not gotten half of that yet. I think that we need a lot more. We need a lot more, a lot faster. Again, the developed world has afforded itself $13 trillion within the space of 7 months. I think $100 billion is affordable and within the remits of the multilateral development banks. But again, the multilateral development banks, many of them just came from capital increases. And so I think there is a little bit of a tension there. They spend all the resources they have. Can they go back and ask for more from the developed world? And that is where we ask the world to commit to capital increases and renew maybe 2 years, and then have a refinancing of most of the development institutions. Otherwise, they will run out of capital as well and face the same problems like the countries. So I think that's the tension. The tension is they must be recapitalized to do more. But I must say the IMF has been amazing and has, leaned forward by just, putting out the resources, ensuring there is more liquidity while asking. And maybe that is what the rest should do as well.
Yeah, it's interesting that the IMF now, with Kristalina Georgieva as its head, who of course has a development and humanitarian background coming into that role, at this moment, it's kind of the perfect leadership type in the perfect institution. IMF never would have been as central to a development conversation as it is right now.
She understands, I think, the tensions between emergency financing and policy reform. I think it's still important to ensure that countries maintain, a positive policy reform track. But I think today is the time when, we have to sort of moderate those tensions and ensure that while countries continue to reform, they get the resources quickly, because the risk is that you backtrack even on the reforms. Not only do you backtrack on the poverty, but you backtrack on the reforms.
Well, and even those reforms, I want to get your take on where you think Africa, again, a lot of diverse economies there, but where you think it goes as this crisis develops, and maybe even after we get out of this crisis. We have a vaccine, let's say the numbers in cases are far down, people can travel again. Even then, tourism might be impaired for a very long time. People might change the way they think about it. Energy prices, to the extent you have several major African economies that rely on exports of oil and gas, it's not obvious that they're gonna do well. You might see a real rotation into renewable sources of energy. You see already, commodity prices for energy far down. Commodities in general, there's a move to push manufacturing closer to consumers, so a lot of onshoring of manufacturing. What is your vision of what the future of the African economy might look like after this pandemic? What's kind of a new vision of development for the continent?
In many respects, we're lucky because we had the African Continental Free Trade Area Agreement, which was beginning to set up what I would call a new vision for how we interact, first of all, with ourselves and secondly with the rest of the world, which was essentially to bring supply chains closer to the continent. We're beginning to talk about regional supply chains, ensuring that we add more value on the continent before we can export. And so I think that, you know, a lot of the reforms that have been taking place over the last 3 years under President Yusufu of Niger, President Kagame in Rwanda, really to set up the African Continental Free Trade Area Agreement, have been almost in anticipation of a crisis, right? You know, making sure that we had the infrastructure in place, opening up our airlines, you know, supporting rail transport development, renewable. And so I think that, you know, first of all, we need to build back better. We need to build back a little bit more resilient. As Christina says, build forward. And I agree, we can't go back to how we were building in the past. There has to be a whole different way of doing this. Investment must come closer. I think now there is also, even in the financing space, a conversation around, you know, methods of financing. Can we use our pension funds better? Can we use, you know, local and domestic resource mobilization better? Technology. How can we ensure that, you know, we can use technology on the continent to the benefit of the continent, and not just be users of technology, but creators of, you know, applications on technology, innovators around technology. I think a lot of these things are happening now as a response to the crisis, but are going to be, you know, reactions that we can then use in other spheres of life. I mean, a lot of the health sort of technology innovations that we're doing because of COVID, tracking, you know, long distance consultations, all that seemed a little bit distant a few months ago, have now become commonplace. And so you can get local doctors to very far from areas in a much faster way. And it is the norm today.
Yeah, I know we're running out of time, but I maybe just ask you one more big picture question, because I think a lot of the development and humanitarian professionals who follow us here at DevEx and are watching this might want to know what you, Vera Songwe, pay attention to. Like, what are some of the big themes or metrics as this goes forward? We're talking about, you know, maybe some kind of a grand deal or country by country deal on debt. Like, what are some of the big things we should be paying attention to that you are watching in particular these days?
You know, right now, the biggest thing that I'm watching, and the biggest thing I'm not watching, because one can't watch, it's sort of, you feel like you need to roll your sleeves and get in there. And so what I'm working on is, and what the Economic Commission for Africa is working on, actually the UN, is one of the things that we're working on is what we're calling the Liquidity and Sustainability Facility. What is the Liquidity and Sustainability Facility? Essentially, it's saying for far too long, emerging markets, frontier markets like ours, have access markets at extremely expensive rates. This essentially is a regressive tax. It's a tax on more or less the wealthy, the commercial banking sector, on developing countries, under the guise of, you know, your risk premiums, we don't know you well, your risk is much higher. But I think those spreads are just unacceptably high. And we need to find some way of ensuring that we can make them lower. One of the things that one can do, for example, is create and strengthen the capital market infrastructure around emerging and developing markets. One of the reasons why in the developed world today, we can see a lot of the businesses that could have gone under because they were not doing well when the crisis started, have not because of an injection of liquidity, because of the creation of repo markets, which allows them to trade their debt much faster for cheaper debt and stay afloat. We don't have any of these instruments on the continent. And so we need to start thinking about how can we can use this crisis to stand up instruments like this. If you reduce our access to money markets by 200 to 300 basis points today, many of the 20 countries that are in the sort of high risk of debt distress category will immediately drop. And I like to give the example of, you know, the debt to GDP of Germany and the debt to GDP of South Africa are the same. But South Africa, Germany pays negative 48 basis points, and South Africa 700 basis points. If you do a race, one of them has 7 pounds on its leg in addition, and the other one has taken up, you know, it's much like the weight. We know who will win that race. And I think essentially we need to start trying to level the playing field. So that's one thing I'm working very hard on, is saying, how can we ensure that we can crowd in the private sector into resolving this current crisis, but also crowd them into seeing how we build forward, because a lot of them have committed to sustainability and to the ESG criteria going forward for energy. Of course, on the continent, we need so much more energy. Africa is the only continent today where you can actually invest in new energy assets, because we're still dark. And so I think a lot of those resources can find a home on the continent, but for them to find a home, they have to be assets that we can afford. They have to be resources that we can actually, you know, use for our development in a sustainable way. So those are the things I'm focused on is cheaper financing for better infrastructure.
Yeah, this crisis is obviously very tragic, but maybe it will open some doors and create some new opportunities. It certainly has showed us people can work faster with more urgency, and they can get together and maybe break through some institutional barriers. What you're talking about is a bold vision. It might sound very technical, but 200 or 300 basis point difference is a really big deal, and
it's billions of dollars in
billions of dollars, right? I mean, it's probably bigger than the foreign aid, budgets to Africa every year. So it's a maybe more than a tweak, but it's a big deal if you can make that happen. So it's something we'll certainly stay tuned into here at DevX, and we appreciate very much you spending some time to talk all this through, and wish you very well in the work you're doing.
Thank you very much, Raj. Most importantly, let's all try to stay safe while we wait for this vaccine, and hopefully we get one soon. In the meantime, wear your masks.
Yeah, wear your mask. Absolutely. Thank you, Vera. Be well, everyone.
Thank you. Thank you.